How should the investors position their portfolio at this point of time in the current market environment? Joining me to talk more on this is Ruchit Mehta, who's the head of research, SBI Mutual Fund. Thank you for joining us on NDTV.
Thank you.
Ruchit, I want to start by asking you that, SBI is coming up with the quality fund NFO now. With quality stocks, the problem which they face is the higher valuation. And since a lot of them are from large caps, how will you get the mix of the right stock at the right valuation and also a broader look on the valuations across broader markets right now?
Yeah. I think the later part of your question is a lot easier to answer. I think given the market correction that's been happening over the past few weeks, the market valuations have come up, particularly let's say in the mid and the smaller cap names, because there has been a lot more of a price correction happening on that side of it. So on a relative standpoint to compared to where we used to be about a year back, things are looking a lot better from a valuation standpoint. Yes, you're right that typically most companies that you would say are quality companies will have a higher valuation. But that's the nature of the beast, right? The reason the valuations are high is because it's a quality company, and there are certain attributes and traits to that business which gives it long-term sort of compounding capabilities. And we will have to be mindful of not overpaying. But also being cognizant that we are not going to be buying something for cheap, right? So it's going to be a fine line to walk, figuring out the right combination of cash flows, return on capital employed, the potential for earnings growth from a long-term standpoint, market share gains, etc., and what is the valuation that the company is available at compared to both its own history and its peers. So yes, compared to say value strategies or general market strategies, a quality strategy is likely to have a higher valuation than the others. Yeah.
Will mid caps have a space in the quality universe? Because there could be some mid and small cap companies which could also be of good quality. And also, you talked about mid cap seeing a correction this year. How do you see that pan out this year for the broader markets and also the mid cap space? And your advice to the investors on that?
So I think the strategy does not exclude any company purely because of capitalization, right? It is not necessary for a large cap to be a quality company, and vice versa, right? So we will have a nice mix of large, mid, and small cap names. What we are looking for is the longevity of the business, right? Is this company investing behind R&D, creating brands, products, technology? Does it have the ability to generate very strong free cash flows? Either it is generating today or it is going to generate, has a potential to do it going forward as well. Is it gaining market share or not? So there's a variety of factors that will go into us determining either it is a quality firm or a franchise today, and or does it have the potential to be one in the future, right? Now, when we're looking of firms that are likely to be great quality companies in the future, it's likely that they are going to be on the more mid and small cap names rather than the well-discovered large cap names. So, yes, the portfolio will have a very nice mix of large, mid, and small cap names per se. Yes, mid and small caps have faced a large part of the correction brunt, but that's also because if you go back to the post-COVID era, the last 5 years, there has been a very material outperformance in mid and small caps. Valuations have risen materially for these companies across the board. So it's not, it is not surprising that the correction has been a lot more concentrated right now on the mid and the small cap side of it. Is it likely to continue? Selectively, yes, because there are still areas where, despite large corrections, valuations or remain very very aggressive. So there are still pockets in which there can still be further correction, and we would generally advise people that in these kind of volatile market environments, you're better off by investing behind, say, large and mid cap, flexi cap, large cap type strategies or the quality strategy, rather than sort of go for pure mid and small cap names. There will be an opportunity in the mid and small cap names, but it will have to be very, very selective, almost very stock specific stories that you will have to look at.
For the commodities bit now, with a lot of global volatility around, what's your view on gold and silver? Because they're seeing a run up here, and even copper seeing a rise, and oil is volatile. So, should investors be worried about this?
I mean, if you are not invested and you're looking at the prices and getting worried about it, or if you are invested and you're enjoying that, I mean, either which ways, right? There are people who have differential views on these commodities. It's going to be very hard to take a call on whether at these elevated prices should one be, still invested or add fresh allocation to these sort of commodities. A better approach is to actually say, use multi-asset allocation funds where there will be an allocation to gold and silver, and the PM will dynamically sort of manage the exposure to these names. Fundamentally, I think commodities or commodity ETFs, they should be part of your portfolio, but ideally not more than 10-15% of your portfolio. The global volatility, uncertainty, central banks moving away from foreign exchange currencies as part of the reserves to going more towards commodities as part of their reserve basket is something that's driving a lot of the current sort of high demand and therefore the high pricing that's there, and it's become a lot more speculative as is. I mean, you have parabolic curves on one side, and while one does not know how high it can go, will it stop now? But history do suggest that eventually you do get a same parabolic down curve, and there can be a lot of tears coming through. So be careful. Make it part of a multi-asset fund strategy rather than just trying to dabble in directly into these commodities.
What impact will this whole AI bubble, this will have on the Indian IT per se? And what sectors are you bullish and bearish on at this moment? Because the budget is coming up, tariff deals are being signed.
So I think there's been a lot of news around AI related companies and the potential impact that will happen on Indian IT. I think the jury is still out there. See, there are fundamentally going to be two sort of impacts, right? One is that a lot of basic work in theory can get automated, and we've seen examples of companies saying that certain percentage of the code is already getting automated by these AI tools. But you would still need humans to validate that code, right? Because the machine doesn't think logically the way humans would, or have the context from a business standpoint and operational standpoint, right? So you will need humans to do that. The second is that there will also be a large demand that can come through from implementing a lot of AI related projects, right? This current technological wave is no different than we saw when cloud computing came a few years back, right? Everybody was worried of what happens to infrastructure management services and stuff like that, and a lot of our companies nicely pivoted themselves and started gaining market share and business on the cloud side of it. So I think it's something similar. It's neither black nor white. It's somewhere in a bit of a gray. And I think at some point in time, when the dust settles, these companies will be nicely positioned to kind of grow. But there are different challenges they have of size and how much more market share they can gain, because in certain traditional areas they're already very high market share that they already have. So I think it's going to be more again stock specific. It's not that it's a complete write off, but there are some nice companies that are taking advantage of this AI bubble that's there. Sectors that we like, so I mean, we like the consumer names, but not so much of the FMCG side of it, more on the discretionary side of it. Given you've had income tax cuts, GST cuts, you have the pay commission coming up as well. So I think a lot of discretionary names will do well going forward. Infra, capital goods, engineering remains a pretty decent area to invest into, considering the amount of capex being invested and a lot of effort on sort of building up manufacturing within the country, be it defense manufacturing or electronics. So there's a wide range of companies that will benefit from a lot of manufacturing revival. Selectively, pharma, healthcare names, IT names, commodities, right? As in more, not so much of the precious side of it, but steel, aluminum, copper, oil. They look pretty attractive. Last year was a very good year for commodity names. This thing could continue for some more time. So yeah, so that's broadly, and there are a lot of other subsegments of the market, right? Like the capital market is quite interesting. There is a transition of the Indian saver going away from fixed deposit to more capital market instruments. So the whole capital markets part of the financial industry looks pretty attractive.
Lastly, what advice for the investors? Should one sit in more in cash, allocate to the market, and also the realistic return expectation this year?
Oh, well, I think you should see whether to sit or deploy in cash or not, or should you start deploying again. I mean, I always try and tell investors is that there is never a right time or a wrong time, right? Especially if you have a longer time horizon to invest into, right? If you're thinking in multiples of 5-year buckets, right? 10, 15, 20 years, then today's market moves doesn't really matter to you. So keep investing, keep doing your SIPs or STPs. If you're thinking very short term, then it's a more of a trader's thing, right? And given the high level of volatility, you'll have to be very nimble about it. But that's not everybody's cup of game. So stay invested, do your SIPs, do your STPs, and think long term. You'll be fine. Eventually, you will generate decent amount of returns that are there. How should one think of returns, right? I mean, here's the way I'd like to think about it: is that if your real economy is growing at about 7% give or take, your inflation is at about, say, give or take 4 or 5%, then the economy in a normal range is going at 14 or about 12 odd percent. If I look at only the non-agriculture, manufacturing and services side of it, then that's growing at about, say, 14-15%. So any reasonable company should be growing at about 14-15 odd percent, right? Then those who are gaining market share obviously would kind of grow faster. And if profitability remains constant, right, not too much, then over the medium to longer term, then earnings should grow in line with revenue growth, right? And if stock prices are long-term reflectors of where earnings growth are, then you should get something different. Now, the only hitch is that what is the price that you're paying? If you overpay for it, obviously your expected return should be much lower. Having said that, the last few years has been fantastic for equity markets. I think everybody would have seen north of 20-25% CAGR on their equity book. Those returns are not going to come back. I think in the last 5 years bull market, it may come back at some point in time, but not this year. I mean, unless you see a further material correction in the market, right? So to get those kind of returns, you need a significant amount of market correction to happen, right? But I don't think markets are going to correct that materially. So you have to be modest on your return expectation. I think given the way the world is volatile, I think if you get low double-digit returns, you should be happy.
All right. Thank you so much for talking to NDTV Profit.
Thank you for having me.